All right, hello everybody. Happy Friday to you all. Welcome into our Inner Circle live trade demo for today. If you guys could give me a quick sound check, I would certainly appreciate it. Just go ahead and give me some feedback inside of the chat box. That would be great. And we'll dive in and start to talk about markets here today. So just want to make sure you can hear me okay. I know it's Friday. I know everybody's tired and distracted by other things coming up here for the weekend, but if you guys could give me some feedback, I would appreciate it. Testing, testing, testing. So just want to make sure. I'm not seeing anybody type in, so I'm just going to trust that the volume is okay. It looks like we've got a quiet crowd here today. No one wants to type in, which is fine. So we'll jump in, start to talk about our trades from the past week or so. We're going to focus in on the option side of things today. We do like to trade a variety of different markets at NetPicks: futures, Forex, options, stocks. We like to do some day trading, some swing trading. We've got a lot of variety going on, but today's focus is going to be on the swing trading side of things with options. That's the core focus of my own personal trading. That's how I make my full-time income from the market. So even though there's a lot of opportunity on the day trading side of things, it doesn't fit my personality. And that's something I talk about in the training quite a bit. A lot of times people get so attracted to the instant feedback that you get as a day trader. You know, the quick profits can be very attractive, right? The problem is a lot of times people force one style or one market to work when in reality there might be a completely different area that's a better spot for them to be in based on account size, based on your risk tolerance and things like that. I don't want you to force one style to work. Bottom line, for me as a trader, I care most about making money. I don't care about being right. I just want to make money. So if I know that I'm going to have a smoother route on the swing trading side of things and it fits me best, that's going to be my core focus. I'm not going to get concerned about what's going on with the futures markets because I know for me, I'm not a very good day trader. It has nothing to do with the systems that we use at NetPicks being bad. It doesn't have anything to do with the markets being bad overall. It has everything to do with me not being able to make those quick decisions that are required as a day trader. So I know myself, I see much better results on the swing trading side. So that's my focus. I don't want to get distracted by everything else that's going on out there. You know, I hear it all the time from people. You know, they want to learn Forex, futures, options. They want to do everything. Well, in reality, if you can find your little niche, you're going to set yourself up for much better long-term success. And my niche is certainly in the options markets. Another big difference between us and many other programs out there, many other companies out there, we are very big believers in taking a systematic approach to the markets and being very disciplined to a set of mechanics. A lot of times people will have an idea of what their system is. They might have a rule set that they learned from an instructor or from another system out there. But if it's not clearly outlined for you on the charts, you're going to find that you're trading off of emotion a good amount of the time. There's a lot of discretionary decisions that come into play. It's really easy to look back and see, hey, I should have done this and I should have done that. But in reality, in real time, in the heat of the battle, when you're using live funds, you want to have everything clearly mapped out for you. That's why we have taken all of the criteria that we look for in a setup and we've programmed it into what we call our trade calculators. When all of that criteria is met, we are going to see an exact entry point. We're going to see two targets, and we're going to see a stop plot right on the chart in real time for us. So it's either a setup or it's not. And if it is a setup, you know exactly what to do from start to finish. It's a huge advantage to us because now we're able to limit that emotional side of trading somewhat. And that's a big area that a lot of times people get hung up on. It doesn't guarantee that we're going to win on every trade. We're going to have winners, losers, and break-evens, just like any other system out there. But if we have that set of mechanics in place that we can stay disciplined to, we know that we're going to win more than we lose, and our winners are going to be larger than our losers. That is the key formula to becoming a successful trader long term. So what I'm going to do today is walk you through a variety of different trades from the past couple of weeks. showing you how we utilize options to our advantage and how we structure our toolbox in a way that we can react to whatever the market is throwing our way, because we know there's going to be times the market's going to be very active. There's going to be times that the market gets very dull and sideways. And ultimately, no one knows what's going to do next. So if you can get that good diversified approach in place, that's going to be ideal. And when we talk about diversification, it's not just in the markets that you trade. Yes, we want to have a good mix of stocks and ETFs and mix of different sectors. That's a big part of it. But on the option side, I also want to make sure that I have a mix of different expiration cycles being used, a mix of different option strategies that I'm using. I'm not just going to buy long calls and long puts exclusively. I'm also going to take a look at some short premium trades as well, because again, the more layers of diversifications that I can get into my mix, the better my equity curve will look long term. I'm going to see smoother growth in that equity curve. So let's go ahead and dive in. We're going to start out by taking a look at our reversal trade here today. This is part of our options fast track program, and as the name indicates, we are looking for reversals in trend. I'm looking for reversals off of overbought or oversold conditions. We have the opinion that over time, the market will move in a stair-step fashion. It's going to make 2 steps forward and 1 step back. Now, on many tech names here lately, on the NASDAQ, it's been pretty much 7 or 8 steps in a row without a step back. But long term, we know that that will all balance out. We will start to get some selling pressure going forward. We've already started to see it in some areas today because the market got so overbought. I'm looking to be active in markets that actively move back and forth. So we're going to start out by taking a look at Caterpillar, symbol CAT. What you're looking at on the chart, you see the pink and the blue dots. That is our trade calculator. That's what I was just describing to you. That prints the entries, the targets, and the stops for us in real time. Most recently, this is the trade that we just closed out here this morning. You're going to see the pink dots. Anytime you see the pink dots on the charts, those represent a short trade. Anytime you see the blue dots, those represent a long trade. Because I had pink dots here, that indicates to me we had an overbought market that was ready to pull back, and fortunately for us, it did so. But what makes it overbought? That indicator down at the bottom, that is the Williams %R indicator. It's a pretty standard indicator in most charting platforms. We do use some custom settings inside of it. In and of itself, you can't identify trades based on the %R indicator only. Overbought or oversold can stay that way longer than any of us expect. It's just one step in the sequence. There's actually 2 additional steps that we look for before we jump into a trade. And the first step is I have to have a close below my signal line, which is that solid white line on the chart. So you can see that that happened earlier in the week. We had a move up above -10 on the %R indicator. That indicates to me that we're overbought. I had a close below my signal line right here. And once the calculator saw that, it plotted the pink dots for me. That first pink dot below the setup candle, that's my entry point. The 2 series of pink dots down below, those are my targets. And the pink dots up above, that is my stop. There's that roadmap for me to follow before I ever get into the trade. Once that setup, once the entry point hit, which it did, you can see, let me get my data box up so we can see the exact value of that entry point. So inside of my data box, you will see that that short entry was at 156.11. As soon as that entry point is touched, I know I need to put on a bearish position. For those of you that are trading stock, you know I could go ahead and short the shares of stock right there. The problem I have with that approach as a retail trader who has access to limited funds, shorting a big expensive stock like Caterpillar, it's going to tie up a lot of capital. It's not the best use of my capital in my opinion. So instead, I want to come in and I want to buy a put option. So I came in and I bought the July 160 puts and I paid $690 per contract. At initial glance, I know that's a little expensive, especially if you've got a smaller retail options account. It's a little bit more expensive because we got more conservative here over the past couple of weeks with our trading. By getting more conservative, what I'm talking about there is I went farther out in time. I'm trading the July monthly options, which have over 30 days left to expiration. I went out farther in time because I was concerned with what the overall market was doing. It kept going higher and higher. During that time, the VIX went lower and lower, and earlier this week, the VIX, well, it still is. It's in the low 12s. When you get a VIX this low, that's telling us there's no fear in this market. When that happens, when the VIX gets low, you can still stay active. It's just going to take longer for trades to develop, and when you are in trades, you're typically going to have longer holding times. Because of that, I'm going to go farther out in time and trade the July options. That way the time decay is not as significant. If I happen to get into a trade and it takes longer than I expect, so instead of getting in and out in a couple of days, maybe I have to stay in for a couple of weeks. Well, if I go out to the July monthlies, I'm able to reduce the impact of the time decay and leave myself with a more conservative trade. A lot of times people will look at that high price tag on the trade and say, well, isn't that a riskier trade? It's tying up more capital. Maybe you should just go with the weekly options. They're cheaper, so they're safer trades. It's not the case. There's more that goes into the pricing model of an option. The farther out in time that I go, even though those options are going to cost more, it's actually a more conservative trade because the time decay is less significant, as is the gamma. For those of you that are familiar with the Greeks, what the gamma tells us essentially is how quickly the prices of the options are going to change for every change in the stock price. When I go farther out in time like this, if I get a big directional move in the stock and it happens quickly, those option prices are going to react slower. So I'm going to be left with a smaller return. Bottom line takeaway here is the farther out in time that you go, you're going to be in a more conservative, slower moving trade. I was okay with that because I was concerned that we're going into the summer months, the VIX is already low, there's not a lot of fear in this market. I wanted to give myself a little bit more cushion here, just in case the trade took longer than expected. Ultimately, this trade actually completed within a couple of days. Once I got into the trade, my focus shifted to the targets and the stops. We actually hit first target yesterday. So once that happens, I can do a couple of things. I can move the stop down to break even, so that's what the calculator did. It moved the stop from the full level up here down to the entry point, so I took the risk off the table at that point. If you're trading multiple contracts, you can close out of half of your position, book the partial profit, which I like to do in this environment because the faster I can lock in a little bit of profit, it's going to improve my reward to risk ratio long term. And then the first thing this morning, we had a gap to the downside. We had some news out overnight. The trade war rumors are starting to pop up again, not only with China, but with Canada and really globally. As a result, there was a little bit of fear, nothing significant. We're already off the lows of the session here today, but it was enough to hit our full second target. Once that level was hit, there's no guesswork in the equation here. I hit second target, it's time to close out of my position. And I did so, booked a $450 profit. That's a 65% return, and I was in and out of that trade in just over 2 days. Our typical holding time long-term over dozens of trades, typically 3 to 5 days. That's what we classify a swing trade at NetPicks. Now you look at that, a $450 profit in and out in just over 2 days. That's pretty attractive, right? That's a nice little supplemental income. You start to trade multiple contracts here, and that's a nice way to replace an income potentially. Because everything's outlined for me, it doesn't take a ton of time from start to finish on this trade. I maybe looked at this chart 20 minutes over the last 2 days, and that's probably a little generous. It probably took less time than that total. So now I'm in and out. Notice down at the bottom, the percent R indicator is oversold. That's key because going into next week, if this market does continue to bounce, which I wouldn't be surprised at all, every dip has been bought the last few years. If that happens, it's potentially setting me up for another long trade going into next week. In order for that to happen, I would need at least one candle to close above my signal line, which is that solid white line. I don't need to spend a ton of time over the weekend trying to justify whether there's a trade there or not on Caterpillar. I can take a quick 5-second view of this chart and see on the far right edge of the chart, there's no pink or blue dots. There's no setup there at the moment. If it happens early next week, great. I'll come in and take a look at putting on a long trade, but it really cuts down on the amount of time that's required to find and manage your trades. Now, before we leave this chart, I should have pointed this out a few moments ago. Let me go ahead and bring up the chart settings. Some of you might be looking at this chart trying to figure out what type of chart is this. It's a pretty clean looking chart, right? There's not a lot going on. There's not a lot of noise there. A lot of times people think adding in a dozen indicators on the chart, the more complex the chart looks, it's got to be more profitable, right? I find the exact opposite is true. The more I add to the chart, the more indecision creeps into my trading. It's difficult to pull the trigger and make a confident decision because there's so much going on. And if I have too much going on, the chances of everything coming into agreement at the same time, it's probably pretty slim. The reason we're able to keep this chart so simple is there's more going on under the hood. We have a lot programmed into our trade calculator, which you've already covered, but we're also utilizing a different chart type. If I were to poll everybody here in the room today, my guess is 95% of you are probably using some type of a time-based chart, whether it be a daily chart, hourly chart, 15-minute chart. It's most likely focused in on a set amount of time. The problem that we have with a time-based chart, if you're using a daily chart, for example, and your system needs a candle to close in order to get a setup, you're potentially missing out on hundreds of points of movement intraday. You're going to find yourself getting into trades late. In order for those trades to work, in order for a time-based chart to work long-term, you need more follow-through. It has to be a bigger, more sustainable move over a longer stretch of time, and that just doesn't always happen. On the flip side, what if the market really slows down? We're going into the summer months, which historically have been much quieter. What if the markets get choppy here? That hourly chart that you're using, the daily chart, it's going to continue to print candles based on a set amount of time regardless of the price action that's there. If the market gets choppy, those time-based charts, they can get ugly. They can get very messy quickly. The range-based charts, on the other hand, this is a range chart on Caterpillar of $1.17 or 117 ticks. What that means is every candle on this chart represents $1.17 of price action from high to low. It has nothing to do with time. It could take 5 minutes. It could take 3 hours. It could take a whole day, for that matter, for a candle to print. As long as Caterpillar moves $1.17, those candles will form. If it doesn't, that chart's not forced to update. It can act as somewhat of a built-in chop filter. It's not perfect. It's not the magic bullet. We're still going to have winners, losers, and break-evens, but it's one way for us to identify the best times that stock is moving. How did I come up with the $1.17? Well, there's a formula that we look at once a quarter. And that formula tells us the exact range setting that we should be using for every name on our list. Bottom line is Amazon's going to move different than Caterpillar. Caterpillar is going to move different than Citigroup. Every name on our list has a unique trading characteristic. Instead of trying to force feed the same chart setup to work on every product on our list, we take it another step and we fine-tune it. We fine-tune every name to the current conditions that we're seeing. And it's a very easy formula to use. It's actually an indicator that we've programmed into our package at NetPicks. It literally takes me 10 seconds a quarter to look up that range setting for each name on our list. So it's a big advantage to us because we know market conditions will change. The markets here this week are completely different than what we saw at the end of the first quarter. The end of the first quarter, the market was pretty volatile. We're right back into that slow grind to the upside here this week. Knowing that market conditions change, what I don't want to do is have a system that works really great, and some of you have probably experienced this. You know, you've got a system in place that's working really well, seeing some nice growth in your account, and then out of nowhere, the market changes, and that system completely falls apart. It's not a good feeling. Not only are you losing money, but now you lose your confidence going forward that system is going to kick back in and start to make you money again down the road. We love to use dynamic systems at NetPicks, systems that self-adjust to the changing conditions. It's a huge advantage long term. Here's where this becomes pretty interesting. If I switch over from Caterpillar, let's take a look at John Deere, symbol DE. Notice the chart looks very similar. The indicators, they're the same. The criteria that we look for in a setup, it's the same. The only difference now is on John Deere, I'm looking at a range setting of $1.20. Now every candle represents $1.20 of price action from high to low. We're fine-tuning the system to each name on our watch list. Right now, the criteria here, because I see the pink setups earlier this week, I knew that the market was overbought. I could see it down on %R. We got to move up above -10. I had to close below my signal line. That gave me my short setup. The calculator knew how to read it. It printed the setups there for me, the entries, the targets, and the stops. This one actually didn't trigger in until 24 hours later. We triggered in right here at 155.61. Again, I came in and I bought the July 160 puts. I paid $744 per contract, a little bit more expensive again because I went out to the July options. I wanted to get more conservative, just given my outlook for the market and given how low volatility was. So I paid a little bit more for this position. Had I known this trade was going to complete within a couple of days, certainly I could have made more money with the weekly options. Hindsight's always 20/20 as a trader. You can always look back and say, hey, I should have done this or that. In real time, I have to take what the market's giving us. I have to make a decision about how much risk I feel comfortable taking given the overall environment. Fortunately here, within a couple of days, we came down, we hit first target. So again, I could close out of half of my position if I have multiple contracts on. At the very least, I'm moving the stop to break even. And the calculator did that for me. It moved the dots down to the entry point. Yesterday afternoon, we ended up hitting the full target. So I closed out of the balance of my trade, booked a $416 profit. That's a 56% return. And we're in and out in just over 3 days. Again, right inside of the window that we typically see long term. 3 to 5 days is a very typical holding time for us. It also gave us an oversold condition on %R. You can see I mentioned the market's off of the low here today, which really it's not a surprise, just given what the market's done the last few years. We're already seeing a new long setup for us. It hasn't triggered in yet, but we had an oversold condition on %R. I had a candle close above the signal line here earlier today. Now it gives me an entry point at 150.93. If that level's hit today, I'll jump back into a trade. I'll jump into some long call options. Now everything is outlined for me. I don't have to guess whether there's a setup there or not. There's a roadmap for me to follow from start to finish. If all you did was trade Caterpillar and John Deere, you're talking about almost $900 of profit here just this week. Some really nice profit, right? Ultimately, I want to have more diversification, and we'll show you that over the next few minutes, but you don't have to trade a watch list of 100 products to make a good return on your investment. We like to master a very small watch list of products. Just avoids any type of confusion. It avoids over trading. It allows us to really get to know our niche well. Let's move on over. Let's start to build in that diversification. Let's move on over to symbol BA. Let's take a look at Boeing. I've already touched on the fact that the last couple of weeks I've tried to get more conservative with my trading. I've cut back on position sizing. I've gone farther out in time, like we talked about, to the July monthly options. That was just due to my outlook for the market, knowing that markets typically get slow in the summer months, knowing that the VIX is already in the 12 handle. There's not a lot of fear out there. I was concerned that we were not going to get those quick trades. The exact opposite has happened. A lot of these trades, a lot of these short trades have triggered in and moved pretty quickly, but coming into this week and coming into the last couple of weeks, I did feel more comfortable getting conservative. So on Boeing, again, the same system, same criteria that we look for in a setup. Everything fell into place for us. We did get a short trade right here at 366.15. This one triggered in back on June 7th. We just hit target this morning, so I just closed out of this position today. But notice the difference here now on this trade compared to Caterpillar and John Deere. We triggered short, but instead of going right down to target within 2-3 days, for the first 3-4 days of that trade, we were underwater. Price action was pulling back. Fortunately, we never hit the stop, but the reason I point this out, if you don't have that trade calculator in place and the stock starts to move opposite of your position, in this case it starts to move to the upside, within a couple of days of seeing that trade underwater, natural instinct says get out. Get that capital, get as much capital back as you can, take the small loss and move on to the next trade. No one likes to be underwater. Well, because that stop wasn't hit, there was no reason to get out of this trade early. Now I'm able to separate myself from a lot of that emotional aspect that holds a lot of people back. If I properly position myself as far as size goes here and keep my risk small, meaning I'm not going to put my entire account into one trade, if I keep my risk small, I know that I can afford to stay more patient. One losing trade's not going to wipe me out. I'm not worried about those losers. Sure, I don't want to have a lot of losing trades, but they're going to happen. It's part of trading. Fortunately for us, we never hit the stop, and look at how quickly this thing changed. We went from almost hitting the stop, and what, 3-4 days later, we came down. We hit that first target yesterday. I closed out of half of my position there, booked a partial profit, and then first thing this morning, we hit that full target, and I closed out of the position with a full target. I did take this in a different way as well. The first two trades that we talked about, all I did is buy long puts. In this case, because it is a $350 stock, we've got a lot of expensive stocks out there. After the last couple of years of this market moving straight higher, there's a lot of overdone names on the upside. Instead of buying a long put here, I actually bought the July 370, 355 put spread. So for those of you that are not familiar with how a spread works, what I'm doing here is I'm buying an in-the-money put. So I bought the 370 put, and at the same time, I sold an out-of-the-money put. I sold the 355 put. What that does is it allows me to reduce the cost on the trade by 30 to 50%. It still leaves me with a risk-defined trade. So just like buying a long put, I can't lose more than whatever I pay to put this position on. I paid $610 per spread. That's the most I can lose on this trade, even if I am dead wrong, and instead of moving lower, Boeing moves to the upside. I know what my maximum loss is. The reason I would put on a put spread, in this case, I wanted to get more conservative. I still wanted to lean to the bearish side, but I wanted to reduce my exposure. Just in case this trade was not ready to move lower, okay, I'm able to stay in the trade longer and reduce my exposure. The trade-off there is, in this case, we came down, hit the full target. I would have made a larger return had I just bought the long put. So by going with the put spread, it's a lower risk, lower reward type of scenario. I was still able to book a really nice profit. I sold it out here this morning, booked a $300 profit, 49% return from a pretty conservative trade. That's a great return. I'm thrilled with that. Given that I was a little uncertain of what we were going to see happen over the past couple of weeks, I'll take that all the time. And now going into next week, just like we talked about on John Deere, I have an oversold condition on percent hour. We got down below -90. So if we get a close above the signal line, that could happen this afternoon, early next week. If that happens, that's going to give me a new long setup, and I will go ahead and jump right back into a new trade at that point. Now, in fairness, we've taken a look at 3 winners. I would love to tell you that it was a perfect week here this week, and I had all winning trades. Not the case. In fact, I love it when it happens, but it doesn't always happen that way. And in fact, it's more the exception rather than the rule that I would have a perfect week with no losers. If I am properly diversified, I want a mix of long and short trades. I want a good mix of products on my list, and as a result, I'm going to have losing trades. It's going to happen. I had a losing trade. Let me show you one of them here on Google this week. Let me zoom out so you can see this. Everything about this trade, it was a short setup. So the criteria that we just got done talking about on Caterpillar, John Deere, and Boeing, it was the same criteria here on Google. We triggered short. I came in and I bought a July put spread here. It just flat out didn't work. The tech names have shown no sign of weakness. These tech names, I'm talking Google, Amazon, Netflix, Tesla, those high-flying NASDAQ names, they just seem to be bulletproof here lately. Apparently, they're all curing cancer because they go up every single day. So as a result, my stop was hit here yesterday. I had to take the trade off when that stop price was hit. I didn't want to. I had the July options on. The market's still overbought. I still think these tech names are going to pull back in the very near future. So why would I take that position off yesterday? I had to because my stop was hit. When I took that trade off yesterday, it was a partial loser. Because there's still 30 days left to expiration in July, those options still had value to them. So I closed it out. I kept my loss as small as I possibly could. Had I held on going into next week and just hoped for a market turnaround, I'd run the risk of letting that partial loser turn into a full loser. Not willing to take that risk. By keeping that loss small, it allows me to battle back much faster. Fortunately, I've had a loser here on Google. Those winners that we just talked about, those other 3 winners, have more than made up for it. What we typically see is our winning trades in most cases, it just depends on how aggressive we want to be in the strategies that we're using, in most cases, our winners are in the 50 to 150% range as far as the prices of the options go. Our losing trades are typically in the 20 to 40% range. So if I can keep those losses small, I know that those winners, they're going to come, and it's going to allow me to recover much faster. Let's add in another layer of diversification. What we just got done taking a look at was our reversal setup. It's a setup that's designed to be pretty active. We're in and out very quickly within a couple of days. The problem with that setup, and that some people run into, it has nothing to do with the system not performing. It can be very fast. And those of you that are working a full-time job, maybe you're working part-time and you just can't look at the charts all day long. It can be difficult because these range settings, these range charts, are focused solely on price action on the chart. You can get a setup at any point during the day. In most cases, you have a period of hours or days before that trade triggers in, but sometimes it's difficult to catch them if you have a busy schedule. So what we did is we came up with a completely different setup type that's a little bit slower moving. It focuses in on a completely different set of criteria, which is really nice because now I can look for a different sequence on the chart and just give me another way of diversifying my approach. This is what we call our Spotlight Power Trader. And for those of you that may have attended one of our earlier live demos, you probably saw Troy cover the Spotlight system on the futures markets. It's a great system for day trading. There's a lot of really powerful returns, but it can also be just as good on the swing trading side of things with options. So let's go ahead and take a look. As far as the charts go, they're going to look slightly different. I mean, it's a completely different system. So if I zoom in here to a chart of Twitter, a little bit different look and feel, different indicator set on the charts, but it also has its own trade calculator. So all of the criteria that we look for in a trade, even though it's different than the fast track program that we just got done taking a look at, everything is mapped out for us in real time. The entries, the targets, and the stops, they're all there on the chart. So this is Twitter. I know a lot of people love trading Twitter. It's kind of the new hot name right now. The names like Twitter and Tesla and Netflix, I mean, they go up just about every day, as you can see on price action on this chart. So what I'm looking at was this yellow setup that I highlighted right here. This one actually set up for us back on May 21st. Instead of having a holding time of 3 to 5 days like we saw earlier on the fast track program, this is a slower moving trade. You're typically going to be in positions for a couple weeks at a time instead of a couple of days. Doesn't make one better than the other. It's just a different approach. It's just a different style of trading. For me personally, I use a mix of both. I like those fast trades at times. I like the longer holding times, going for the bigger setups here with the Spotlight system. So now, you know, getting that good mix of trades in, it really has improved my results long term. This yellow trade, essentially what we're looking for, we have this moving average. It's actually an exponential moving average that I have on the chart. It's this solid blue line moving across the chart here. We have these 3 blue and green dots right there. Those are what we call our exhaustion dots. And when those exhaustion dots come very close to our moving average and price action bounces back to the upside like it did here, that's what gave us our yellow setup. So we saw price action start to consolidate right in this little section here, and then it shot higher. So the system gave us an entry point at 33.92. That's where we initiated our long trade. The reason I love the Spotlight system is we have a completely different set of mechanics for trade management. On the first 3 trades that I showed you, we were going for very fixed targets. There was no trailing stop. I wasn't keeping part of my position on, going for the home run trade. I wanted to get out as soon as possible at a fixed target. With the Spotlight Power Trader, we have actually added in the option to use a trailing stop and go for the bigger winner. So what I did here on Twitter, when that entry point was set, again, everything's outlined for me. I have my targets up above, my stop down below. I came in and I bought the July 32 calls, and I paid $330 per contract for those. I had my second target, which is this upper yellow dot there on the chart. That is where I'm going to exit part of my position at that fixed target. For me, I closed out of half of my position at that full second target, which I did, and I booked a $485 profit. It was 147% return. I had to hold longer, right? This trade triggered in back on May 21st. We did not hit that second target until June 5th. So I had to hold a little bit longer here. That's just the nature of this system. But then at that second target, I also kept half of my position on, utilizing a trailing stop. Notice how as I started to go up into profit here, the stop started to move up. See all these yellow dots making that stair step move to the upside? That is my trailing stop. So on the second half of my trade, I've been moving the stop up as we go. So worst case scenario, I've got a profit locked in. I still have half of the trade on here. I have not closed it out yet. As of this morning, last time I checked the pricing of the second half of my trade, it was trading for around just over $15. It might be different now. Obviously, the market's been moving here today. But right now, I've got about just about a $1,200 profit. That's a 360% return on the second part of my trade. Now, I'm almost a month into the trade, so I've had to hold much longer, but it's not something I have to sit there and watch all day long. I'll come in and check the charts a couple times a day. Grand total, it takes me about 20 minutes a day to check the charts. That's really what I allow for my trading. So it's not something that you're going to have to, sit down from opening to closing bell. That's not the whole idea. By holding this trade for almost a month, there's really a couple minutes here or there, a couple hours here or there, a couple days here and there. It's not going to make a huge difference. Right? So really great position here. And then again, who knows? If the move stalls out here, worst case, I'm out with, over a 300% profit. There's nothing wrong with that. I'll take that, every month, right? If it continues to move to the upside, who knows? These tech names, it just has shown no signs of weakness. If it continues to move to the upside, I'm playing with house money at this point in a big way. So just a phenomenal trade there on Twitter. And notice the names that I'm showing you. I've shown you Google, Twitter, Boeing, Caterpillar, John Deere. Not only am I showing you a different set of trade types, I'm showing you a different set of markets, different systems. We're getting that diversification that we absolutely want to have. Now, a couple other trades that I have on right now. Let's jump over to QQQ. Let's take a look at the NASDAQ ETF. So if I take a look at the NASDAQ ETF, which is QQQ, we had another yellow trade, which I'm highlighting right there. It's right around that red arrow on the chart. That indicated to me that there's a long setup right there. And that entry point was hit about a day and a half later. That entry point was at 172.11. I came in and I bought the July 170 calls for $4.74. So $474 per contract. Well, notice what's happened here. Price action, it hasn't made an immediate move higher. It's just kind of been that slow, methodical grind higher over the past couple of weeks. Well, this trade triggered in back on June 1st. Since then, it's just been a steady move higher. I haven't hit my fixed target yet. I haven't hit that yellow dot on the upper level of my chart, but I have moved far enough to notice where my stop's at. My stop is now at 174.94. Worst case scenario, this market's tired. It absolutely is. If it turns going into next week, worst case scenario, I've got a partial profit booked in. That's a good feeling going into this weekend. Right? I don't know. Let's just see. Let me jump over to the trade page here a second. Let's just take a look at the current price of these options. So we're in July. We've got the 170 calls. They're currently trading for around $8.12. I bought them for $4.74. So working out nicely, right? We're approaching a $400 profit there on the QQQ position. So does it guarantee that we're going to hit the full target? I hope it does. It'd be great if it does, but worst case scenario, I've already got a decent profit locked in because I've got that trailing stop in place. So really nice position there on QQQ. Let me switch on over to another workspace here. Let's take a look at IWM. This is the Russell. The NASDAQ and the Russell have just been pretty significant market leaders. The Dow and the S&P, they've been trying to play catch up. They've been trying to get into the ball game on the upside here earlier this week, but the strength has really been in the Russell and the NASDAQ. We just took a look at the NASDAQ. Well, this Russell chart is actually even more impressive. If I zoom out, I mean, you can see this has been a pretty steady move to the upside here. I should point out on this SPT trade plan, this is a 195-minute chart. So I am using a time-based chart, which coming into the Spotlight Power Trader, as I mentioned earlier, I was not a big fan of the time-based charts. They can work, but you do need bigger moves. You need more sustained moves, meaning they need to stay in place longer, which we've had some of that, but I like to have a good mix. I like to have those range-based charts in place because, as you can see, they allow me to get in and out much faster. But I can also mix in some of these longer-term trades as well, and they work out just as good. I mean, here on IWM, we had this yellow trade. This was back on May 21st. Entry point was outlined for me on the chart, 163.10. We triggered long, and we just had that steady move to the upside. We came in and we bought the July 161 calls. I bought them for $4.60 or $460 per contract. They are now trading, let's go ahead and bring it up the trade page here, as long as Thinkorswim will cooperate. So the 161 calls out in July, they are now trading for $7.28 or so. I bought them for $4.60. I've got a really nice profit on the table at this point. Again, I'm approaching that $300 profit level per contract. That's a really nice return. Hasn't been the quickest trade. It's not a trade that I'm in and out in a couple of days, but it's a great complement to those earlier trades that I showed you, those faster moving trades like Caterpillar, John Deere, or Boeing. By building in that diversification, I know I keep saying that, but it's so crucial in this market because we're not getting broad-based movement. How do I know that? Well, if I take a look, let's just go to some internals charts that I look at. These market internals will basically take a look at today's session in more detail, take a look under the hood to see how strong or weak the market is. The upper right chart here, the upper right corner chart, is the advanced decline line. It's telling me how many advancers versus how many decliners we have on the session. Right now, that number is at minus 500. If this was truly a washout move to the downside where everything is going to move to the downside, we would have that number at minus 1,000, minus 1,500. That would indicate to me that there's across the board selling. It's only at minus 500. That indicates to me that there's a lot of indecision. I point this out because on the upside, even yesterday, I mean, we've had some pretty strong markets here this week. Yesterday, the advanced decline line for most of the day was less than 500. It was below plus 500. The strength has been in the tech names. It's been one small cluster, the FANG stocks, so Facebook, Apple, Amazon, Netflix, Google. I mean, it's that same group of stocks that continues to prop the entire market up. It's not broad-based. It's not in every sector. It's not in every stock. That's why going forward, no one knows what sector is going to kick in next. Is the tech sector going to pass the baton back to some other area? We don't know. So having a good mix of names is the best way to go. You don't want to jump in and just say, well, the tech names, that's where the action's at. Let me just focus exclusively on tech. That might work in the near future, but going forward, our leadership might completely change over the next few months. No one knows. What I'd rather do is have a good mix of stocks and ETFs, a good mix of sectors covered, good mix of setup types like we've talked about here today, some short-term reversal trades, some of the longer-term position trades with the Spotlight Power Trader. If you can do that, you're going to see the more consistent growth in your equity curve. That's why what we do at NetPicks, by building out our toolbox, that's what makes a big difference in your results long-term. That's a big mistake that I see a lot of retail traders make. They don't have enough of a mix of different approaches, different markets and different setup types. And they don't get their sample set of trades big enough. Instead of taking 5 or 6 really small trades at a time, most retail traders are taking 1 or 2 big positions and just hoping, fingers crossed, that those work. Well, it's not a formula. It's not a recipe that's going to work long term. You might hit it lucky, a couple times in the near term and it feels good, but long term, the market's just it's gonna chew you up. And I say that because I've been there. I've made all the dumb mistakes that you can imagine over the years. Fortunately, I've been able to overcome those mistakes, and that's why we've developed the tools that we have. It's on the option side. I do run all of the options products for NetPicks. These options tools have been developed in response to all the struggles that I had when I first started trading, in the first couple years back in 2002. So now to have that methodology in place, it's made a world of difference in my own trading. But actually, let's take this one step further here. To this point, we have been focusing exclusively on directional trades, right? I mean, the trades that we've talked about so far, bottom line is we need the market to move. If I buy a call or a put, or if I buy a vertical spread, I need that market to move in order to make money. If the market doesn't move, if we just chomp sideways, it's going to be a difficult go. That's the dreaded move that a lot of people struggle with, whether you're day trading or swing trading. It's when the market gets sideways and choppy, that's when it gets difficult because you're just spinning your wheels, you're adding up commissions with nothing to show for it. Options are the one area of the market where you can still stay active and generate some profit if the market is doing absolutely nothing. That's a big reason why I was attracted to these markets years ago. So let's talk through, this is a chart of GLD. What we did here on GLD, this was a couple of weeks ago with our Options Express program. Instead of coming in and buying a call or a put, we came in and we sold a put spread. We sold the 123, 122 put spread, and these were the options expiring here today. Okay, we actually closed this trade out yesterday, but we collected 34 cents or $34 per spread. What I'm doing on this trade is I'm selling the 123 put and I'm buying the 122 put to make it a risk-defined trade. Instead of paying for those options like we did on the earlier examples, now I'm collecting premium up front. I'm selling the spread to collect the premium. It's still a risk-defined trade. A lot of times people get intimidated by selling options to open up a position because they think there's a lot of risk involved there. Well, not when it's a spread. It's a fully risk-defined trade. My maximum loss on this trade would have been $66 per spread. That's the amount of capital that's required to put this trade on. It's taking up less than $70 of capital to put this trade on. So for those of you that have a smaller account size, this probably looks pretty attractive. Now you can trade a $125 ETF with less than $70 of capital. Pretty phenomenal. I mean, if you've got a larger account size, sure, you can take this with 10, 20 spreads. Put it on with 10 spreads and you're still talking about less than $700 of risk. Very reasonable regardless of account size. Now, when I put this trade on, my outlook for gold was bullish. It's still bullish. I know gold is just taking it on the chin here today. Gold is just getting demolished here today. So I was dead wrong on my outlook for gold, at least in the near term. When I sell a put spread, it's a bullish position. I want gold to move to the upside. Well, notice what happened here. We didn't really move to the upside. We kind of settled into a sideways chop. We finally got a little bit of a push to the upside yesterday. What we did is, it wasn't huge, but we sent out an alert to our students to close out of the trade and book the partial profit. We closed it out. We bought it back for 9 cents. It gave us a $25 profit per spread. You're saying so you had a bullish position on and you made money from this move right here that I'm circling, that sideways chop? We did, because here's the beauty when you sell options. I have 5 different ways of making money on this trade. I make money if GLD moves up, down, or sideways as long as it stays above, and that's actually that break-even point. That is incorrect. It actually has to stay above 122.70. So it has to stay above. Let me get that out of there so we can move the line so I can show you here. So it's right around 122.70, right around that line right there. As long as price action stayed above that line, I got to make money. So if it moved up, if it played out to the upside like we were expecting, great. If it moves sideways, sure, I can make money from that. If it moved to the downside, if I was dead wrong, I'm still okay as long as price action stayed above 122.70. I also make money from time decay adding up, and I make money from volatility decreasing. When I buy an option, the minute I buy that option, it's like holding a ticking time bomb. the time decay is going to hurt you every day that you hold that trade. Now, we can offset that time decay as long as the directional move happens in your favor. But we don't always get those directional moves. That's why in this case, because we sold the options, we sold the spread to open up the trade, now I put the time decay in my favor. Every day that I hold that trade, that time decay is helping me. That's how I made money on this position. I didn't get a big move to the upside, but it was enough. We closed the trade out yesterday because expiration is here today. We had a partial profit yesterday. I don't like to hold in the expiration, and here's a perfect example of why that is. Had I held into today, I would have gone from a really nice profit to essentially a full loss immediately because we had that big move to the downside. That's why we took action yesterday. That's why we sent out the alert to all of our students, close out of the position, book the partial profit, and move on to the next trade. And that's exactly what we did. So at $25 profit, you're looking at that saying, why are you getting excited about that trade? It's $25. Remember, it only tied up $66 of capital to begin with. You put it on 10 times, all of a sudden, I've got a nice $250 profit within a couple of weeks. Are these trades designed to have home run profit potential? No. That's not the design of the trade. That's not why I put it on. I put it on so I can collect a little bit of premium, generate some profit or some income if I'm not expecting a big directional move immediately. We do not fall into the camp at NetPicks of believing that you should only buy options or only sell options. I know there's people on both sides of that fence that sell products. I like a good mix of both. I like to mix both because, again, no one knows what the market's going to do next. The Twitter trade that I talked about, the Caterpillar trade, the John Deere, the Boeing trades, those are the trades that are going to give me the bigger profit potential. It's a big part of my portfolio. But what happens if the market's not making those big moves? That's where this type of trade on GLD, where I'm selling a spread, that's where those trades kick in and still allow me to stay active, generate some income if the market's not making a big directional move. Hopefully you can start to see this picture that I'm trying to paint here. We have all these different pieces of the puzzle, right? Different markets that we're trading, different setup types, different types of option strategies. And it's all coming together to form a puzzle for us where we can generate those consistent returns over time. And that's the big issue for most people. They are not able to get to that point. If you're not trading options, you might be looking at saying, okay, Mike, you're talking about terms that I'm not familiar with. Selling premium, selling a spread, a vertical spread, different expiration cycles. What does that all mean? Well, the goal is not to sell you anything today. That's not the goal of this presentation. We're just trying to show you how we approach the markets at NetPicks. But what we have done is we've included all of the tools that we've shown here today. We have a comprehensive training program, and we walk you through exactly how we identify these trades. How do we take them from start to finish? All the custom indicators that I've shown you here today, you can actually download into your computer, download into your own charting platform, and see those exact same chart setups. That way you're in complete control of your trading. The goal is to get in and out in about 20 minutes a day or less. I come in once in the morning, once around lunch, and once in the afternoon around the market close. Grand total about 20 minutes a day. That's what I do to check the markets, place my trades, manage my trades, and I'm able to make a full-time income doing that. It frees up my schedule for other things. I can trade anywhere I have an internet connection. It's a very powerful approach. Maybe you're not interested in trading options exclusively. That's fine. Maybe it's a complement to what you're doing on the day trading side of things. We have some really successful students right now that are active on the day trading side, but they're getting that diversification by also mixing in some swing trading with options or Forex. I think it's just a great approach to the markets. Now, I didn't get a chance to go through our entire watch list here today. We do trade names like Apple and Facebook and Tesla and Netflix. There's probably some questions on, what have you done on those this week? I just didn't have time to get to all of those. On a good number of those, we haven't had setups because they're so overbought. I'm waiting for reversals. I'm waiting for this market to roll back over to the downside, and it just hasn't happened yet. That could potentially come next week. That's the great part about it. If this market does decide to roll over next week, there's going to be a tremendous amount of opportunity for us on many of these overbought markets. We're going to get a whole slew of new setups, which I'm really looking forward to. I think we're due. We're getting close to a decent sized pullback, which Be really fun to profit from. So what I'm going to do here in the chat, hopefully you guys can see that come through in the chat box. If not, go ahead and open up that chat box so you can see it. I put a link into that chat. What we are offering right now is a free 30-day trial, free 1-month trial to all of the tools that I showed you today. All the tools that Troy has shown you in previous webinars on the day trading side of things. We're opening up everything that we have, all the indicators, all the training. You can try it out for a month free on us. Go through the training, get the indicators downloaded, maybe take some trades, generate a little income. It's no cost to you. At the end of that 1 month, we can certainly talk about the different price points to purchase the product. We're not going to cover that today because, again, I'm not trying to sell you anything. I just want to give you an opportunity to try out the tools. So go ahead and click on that link in the chat. For those of you, if for whatever reason you can't see that, the link is netpicks.com/IC free trial. So IC as an inner circle and free trial. So go ahead and visit that link. Give it a shot. If you have any questions at all, I'm trying to check the chat here now. Pretty quiet group. So either you guys are ready for the weekend or you just don't have any questions, which is completely fine as well. But if you think of anything or need more details from me, feel free to send me an email directly. My email is mike@netpicks.com, which I will also get into the chat box. And go ahead and send me an email, and we can certainly connect for a phone call if we need to, walk through any questions you might have. We want to make sure you get on the right track with your trading. The reason why many of you are here today is you're active in the markets, but maybe you're looking for a way to improve your results. Maybe you want to get over to that profitable side once and for all. Well, we'd love to talk with you and see if we can help get you over to that point. Right, so if there's no questions, I'm going to go ahead and start to wrap it up for today. I really appreciate your time. Thank you for joining us here for the presentation today. Enjoy your weekend, everybody. We'll be back here 2 weeks from today with our next live demo, and that one will be focused on the day trading side of things with the futures and the Forex market. So if you would like more detail on the day trading side of things before then, send us an email, and we can certainly send you a recording of the last webinar that Troy did on the day trading side of things. We'd love to get you that information. All right, so I appreciate all of you guys joining us here today. Hopefully you found it beneficial. Again, enjoy your weekend, and we'll talk to you guys here in the near future.